Rob Beardsley, thanks for coming, and then we're very happy for you to come to this show today. And just before we started, I just want to set up the stage. We're in New Orleans today, have a good time. This is a commercial real estate retreat, right? We are talking about deals, capital markets, interest rates, all those good stuff. But more importantly, we're building the relationship, get to know each other even better, and for a future partnership. So I think that's the in-person relationship has the magic more than anything else. Okay, yeah. So I know you, Rob, as the founder and the principal from Lone Star. You guys have a large portfolio, more than 3,000 units now, and then transaction volume, I think it's beyond $350 million, large portfolio. And also I know you as the author for not one but two very good books. I really enjoyed them. One is the definitive guide to underwrite multifamily acquisition, and one is my favorite here, structuring and raising debt and equity for real estate. Right? We talk about all of them in a second, but before that, tell us what triggered your interest in real estate in the first place, and how did that lead you to fund Lone Star? What's the story for that?
Yeah, my relationship with real estate starts very early on.
Yep.
I grew up in a real estate family in Silicon Valley.
Yep.
So my parents ran a residential brokerage firm called Menlo Atherton Realty.
Okay.
They bought and sold luxury homes for their clients, and they also did single family flips and construction.
Yep.
So everything they did was on the single family side, and they were kind of in the middle class trap of working very hard, having a high income, but also high expenses.
Yeah.
And for me, that didn't really resonate with me, and they also, because we grew up in Silicon Valley, they pushed me to go into tech.
I see. Yep.
So I went to college at Carnegie Mellon to study computer science.
Yep.
I thought I was going to go into a startup or consulting or something like that.
A typical Silicon Valley story there.
Yeah, exactly. Yeah. And however, while in college, my intellectual curiosity led me back to real estate. Actually, I was just learning online. Well, how do I make money? If I'm going to get rich from a startup, what do I do with the money? I need to invest it. How do I invest? And so that's when I started getting really into multifamily, not single family, because while my parents were, you could say, successful in the single family side, they were working very hard for commission checks and for transactions, not for assets and equity.
Yeah.
So when you go from single family to the multifamily business, it's much more a model for long-term growth, for building more of an institutional and vehicle better for scale.
Yep.
So that resonated with me, and before you know it, I had met my business partner and I started our company, Star Capital.
Yep.
And then after we put our first deal under contract, which is a nearly $20 million deal in Houston, I actually dropped out of Carnegie Mellon and moved home.
I see.
And then eventually made my way to move out to New York to really formally start the business.
Was that your first deal, $20 million?
Yes.
Wow, that's amazing. That's amazing. So what's your main role in Lone Star these days?
So my main role is acquisitions and capital markets. So my business partner, we've split up the business very nicely amongst ourselves. I focus on working with our acquisitions team to find new opportunities, develop the strategy, negotiate deals, underwriting, and then also I work with on the debt side of things, and then also spend a lot of time on the equity with our investor relations team to go out and raise capital.
I see.
And deal with the many investors that we have.
Got it.
And then my business partner he's formerly a tax attorney, and so he has a lot of legal experience, which helps a ton on all the legal side of real estate. There's a ton of legal involved that many people maybe overlook.
Absolutely.
And then he also runs our asset management team and our property management team.
Got it. Makes sense. I think you already mentioned this briefly. For our audience, a lot of them are familiar with single-family rental investment. Some of them even familiar with REITs, right? So from a very established syndicator, a partner, a sponsor standpoint, how do you usually explain to people what multifamily syndication is, and comparing to traditional single-family rental and the REITs, what are the advantage of this asset class?
Well, there's a lot to unpack there, because you've got the single-family versus multifamily element, and then you have the REIT versus multifamily private real estate element, right? So first, focusing on single-family versus multifamily, a lot of the things that make single-family investing attractive are twice as good for multifamily. For example, people like to invest in single family because of the tangible asset component, right? It's a real hard asset. It also provides cash flow by way of rental income. However, with multifamily, you have a diversified stream of cash flow. Instead of relying on one tenant where your revenue is essentially binary, 0 or 1, you now have maybe 100 units, and if you lose a tenant, it's diversified and it's not as big of a risk to your P&L.
Makes sense.
So that the sort of diversification of your revenue stream is very valuable, and then on the expense side you get economies of scale. And especially when you get to our size where you can bring property management in-house and get more creative and more hands-on with the way you manage the portfolio, you can drive down costs and really try to operate with the most efficiency and transparency. So those are the real fundamental, basic, simple reasons as to why multifamily is much more scalable and conducive to generating enduring cash flow.
Makes sense.
The REIT versus multifamily argument is rather different. So REITs are, as you know, a public vehicle for investing in real estate. And I think that there's certainly value to having liquidity, but liquidity also comes at a cost and actually can be a negative. So what happens when you take a great asset like real estate and then you put it on the public markets is you make it behave like a public equity, right? And so the correlation to public equities is greater, and also you're paying a liquidity premium. So actually you're getting less cash flow and you're effectively paying more for this collection of real estate assets because it is liquid. And for me personally, because I think about investing long term, and also I'm human just like everybody else, so I'm emotional. And when the stock market goes down, it's very difficult to be in control of your emotions and not want to panic sell.
Got it.
That's the beauty of illiquid assets, because with our real estate holdings, we're not going to panic sell, because with real estate, it's a slow moving animal. It takes a long time, and you can make decisions over many months because you can't just press a button and sell your property, right? It takes like 6 months to sell something. You have to think about it, you have to get broker's opinion of value, and then you have to prime the deal for sale, then list it for sale. There's the whole process. So it takes some of the emotion out of the game and also gets you thinking more long term. So for me, those are kind of the advantages of private syndication over REITs that really resonate with me.
Got it.
But there's other things that I would argue just more so on the cash flow level, like we discussed. So yeah, I mean, I think there's pros and cons, but we are, I think we're in the right place.
Makes sense. So, and also, if I understand correctly, REITs being a public sort of a equity-like asset class, it's still highly correlated to the overall stock market. From a hedging standpoint, private equity syndication is a lot more detached from overall stock market versus REITs. Is that a correct understanding in general?
Yeah, I wouldn't say a huge difference, but there's definitely a difference.
Got it. Yeah, makes sense. Okay, sounds good. And then now you talk. So one of the things you talk about between those two is the return is a bit different. So I know the term typical is kind of vague, but how should an investor expect from investing in multifamily syndication from a return standpoint? And then what's the average holding period, at least in the assumption?
Right. So we typically look at holding deals for 3 to 5 years.
Okay.
And that varies based on the business plan as well as where we are in the market cycle. So there's always going to be variability there, but 3 to 5 years is the target. And over those 3 to 5 years, we look to generate somewhere around a 16% return for investors. And that's an annualized return. That's an IRR, actually. And just to put it in really simple terms, we generally aim to somewhere around double investor capital over 5 years.
Sounds good.
So that's a 2x equity multiple.
Correct. Yeah. So for the audience, that means essentially if you put down 100K in day one, at the end of 5 years, the goal is to return 200K to you via your capital, return all your capital plus all the distribution for cash flow and plus the appreciation at the sale proceeds at the end. Okay, makes sense. And usually, I got this question a lot. Who can invest in those deals? Is that only for institution, ultra high net worth individual, or retail investors as well?
Yeah, so this is actually a very interesting topic because, well, private individuals have been investing in these sorts of private syndication deals for a long time.
Yep.
It's been kind of clubby. Country club, a real estate developer has friends and they invest
inner circle type of thing.
Exactly. And it wasn't until 2012 with the Jobs Act that this sort of investment opportunity was broadened to the general public, to accredited investors and sophisticated investors.
Yep.
So it's actually somewhat of a relatively new industry for this to be possible, but it's grown tremendously, as you know, and there's a ton more people investing in the space, which is fantastic because I do think it is a superior way to invest for a lot of people than just putting all their money in the stock market or what have you. So, that's it's relatively new, but it's now accessible to a lot of people. I mean, we have investors of all shapes and sizes. Whether we're talking about, our minimum investment is $50,000. And we've even on a case-by-case basis, if it's like a family friend or something, we've allowed smaller than that.
Got it.
And then we have investors who are big, sophisticated investors who are investing $1 million, $5 million, $10 million. And
those are institutions like family office, all those type of.
Yeah, it can be either ultra high net worth individuals or family offices or private equity funds that are formed for the purposes of investing with operators like us.
So you guys work with fund managers as well?
Yes.
I see. Can you elaborate a little bit, because you mentioned a term called accredited investors. What does that mean for our audience?
So an accredited investor, last time I checked, is an individual who makes $250,000 per year and or has $1 million in assets excluding their primary residence.
Got it.
So it's basically the SEC's qualification to deem an investor sophisticated enough or of a certain caliber to be able to invest in a private offering like this. And it does make sense on some level. I think it's a little bit bureaucratic and it does prevent some people to invest or makes it a little bit more difficult for individuals who have a harder time proving those things about themselves just based on maybe the nature of their income or their business. But in any case, it does somewhat make sense because one thing I'll just tell you from personal experience is we never want to take an investor's only $50,000.
That's right. Yeah.
Because they're going to be very stressed out and they're putting all their eggs in one basket. One deal is not diversified. So we don't want, frankly, we don't want those kinds of investors. We would much rather have sophisticated investors that are comfortable making long-term decisions because the funny thing is this is not the stock market where you can buy and sell just whenever you want. This is a long-term partnership. So we want to make sure that they're comfortable and understand that we're going to make money together for a long time.
So from a sponsor, a syndicator standpoint, you want to find the right investor as well because there's two-way choices, right? Investor finding a good deal, good sponsor, but you also want to find the right investor to work with. Is that a fair statement? Yeah,
absolutely. It's funny, when we first started out in business, we were trying to chase down any investor we could find, right? And we would maybe make short-term decisions that weren't in our best interest when we knew deep down partnering with this person maybe wouldn't be the best fit.
It's not right for
but we would just put up with it because we didn't feel like we had another choice. And fortunately now we're in a position where we can actually vet our investors and partners a bit more and try to work with people who we really resonate with and enjoy working with on a long-term level.
Makes sense. So let's say if I have 100K, I want to invest. It seems to be a good property. I like the location. It sounds like this has a good return projection. How can I make sure my money is in good hands, meaning the sponsor, the syndicator, is legit and trustworthy? And then what are the things I can do to make sure that's the right person to manage my money in this deal?
Yeah, you're pointing out all the right things because the sponsor is really, really important to get right. Because if you want to invest in a certain market or in a certain strategy, that's great. But if you don't partner with the right sponsor, that can cause a lot of problems for you down the road, right? You could be investing in the best deal, but it could go sideways because if you don't have the right manager in place. So I think thinking from a sponsor-centric approach is really valuable. And it's valuable because it also helps you as the investor to become more comfortable and to spend less time and effort finding and investing in deals,
Yep.
right? Because the goal of being a passive investor is to be passive.
Yep.
You don't want to be having to underwrite a ton of deals and sifting through a bunch of documents to decide what to invest in.
Yep.
So I think it's really valuable to find sponsors, vet them out, and pick sponsors that you want to work with on a repeat basis,
Yep.
because that rinse and repeat will be able to save you time. So as far as actually finding sponsors and vetting them, I think trust, as you know, doesn't happen overnight.
Yeah.
So it's wise to take time to build relationships and to start slowly. The thing is, once people discover this industry,
Yeah.
they get very excited
Yeah.
and they want to invest all their money right away.
Right, yeah.
The problem is maybe the way you discovered it or the first person you meet in the space is maybe not the best person to invest with.
Yeah.
So it's good to take it slow, meet a lot of people, and start to compare and understand the business better. Because I would say it only takes maybe 6 months to really get a much better understanding of how things work. So I would ask for due diligence materials on the sponsor. Certainly track record is a great place to start. Just understand, okay, is their track record, are they experienced? Do they have wins? Do they have losses? And not just yes or no, but can they speak to them and explain how that deal went? What were the challenges? How did they overcome those challenges?
Yeah.
Really getting to know all of that. And through that process, you'll see how professional they are and how organized they are. If you request a certain document like their track record or a case study or something like that, or a referral, do they have to scramble to put it together? Does it look professional? Is there missing data?
Yeah.
Are there inaccuracies?
Yeah.
I think the little things, this is just for me personally, I think the little things are indicative of the big things.
Yeah.
And so we pride ourselves on doing the small things great and making sure that we provide great information timely and that we're transparent. So I think that's a really great place to start, because as you know, and based on your background, anything we do in real estate is not going to be as complicated as what you do in tech, right?
Yeah.
So real estate's not rocket science.
Yeah.
It doesn't take a genius. What it does take is hard work and a lot of just care and attention.
Yeah.
So if we can show that we can be caring and attentive to our investors, then it also is reflective of our ability to be caring and attentive to our tenants and properties.
Correct. Yeah, the reason why I'm asking this specific question is I get a lot of questions from my investor. Which markets should I invest in? Which deal should I invest in? So I usually tell them, this is actually the secondary question. The first question is always, who should I be investing with, right? The person is always the number one reason we choose where to invest, regardless the markets. If a sponsor team, a syndicator team is good, they are smart enough to find the good deals and then manage them well, not the other way around, right? So if not a strong sponsor can make a mediocre deal great. And then vice versa is also true. A mediocre sponsor can make a great deal not that great, right? So that's why I always focus finding or working with the best sponsor in the industry first. I think that's the number one priority, at least for me and for my investors. Yep. Okay. So next section, we're going to talk more about you, and then Lone start a little bit more specific. So we started from books. So two really good books. Again, Definitive Guide to Underwriting Multifamily Acquisition, and then Structuring and Raising Debt and Equity for Real Estate. Those two books have literally hundreds of 5-star reviews on Amazon. People really like them and read them, right? Because they are concise, they're short, but they're to the point. So my question is, why did you choose those two specific topics to write about versus other places? And then what kind of impact they bring to your career after you having them?
Yeah, absolutely. So the first book was, I didn't have a master plan to write it and then write the second book. It started with, actually, when I first got into the business, I was seeking that exact resource. I wanted to have a quick understanding and a in-depth understanding of how to analyze and underwrite property. Yeah. And I didn't see anything out there in the market. So I told myself that once I built up the expertise, I would then write that book and fill that niche in the market.
Yeah.
And it just felt like a good thing to do, and it felt like the market would really value it.
Yeah.
But I didn't have any idea as far as how well it would sell or what it would really do for me. But thankfully, it's done tremendously well. We've sold well over 10,000 copies of the first book, and it's grown our network tremendously. We've made a lot of new connections. We've met a lot of investors from that book. And the success of that book really inspired me to then write the second book, which is right here. And the second book builds on the topic of the first, because the first book is about underwriting property, which is just the financial analysis. But just because you can analyze a deal and the numbers look good on paper, the next step is really actually structuring the deal.
The debt.
And you have to have the debt in place, the equity in place, and then you've got it all together and you can close, right? So, and what I like about this second book is it is a more creative topic. Because with underwriting, it's not as creative. You basically just have to plug in the numbers, crunch the revenue and expenses and all this good stuff. But with debt and equity, it's creative. You can kind of develop your strategy and then match the debt terms with the strategy. There's negotiation. So I like the creative elements of that part of the business. And what I also like about this second book is it's a broader topic, so we could reach a broader audience. So with kind of more experience and a bigger network, we're actually doing really well on the sales of this second book. We're, I think, double or triple the pace of the first book.
I see.
And we have, continued to grow the network and whatnot. So I'm really thankful. I never thought I would write a book or anything like that. I never was known as a good writer, but it has been a great journey, and I really appreciate what it's done for us.
Nice. So let's say now we know you are the expert on underwriting and then structuring the debt, right? So, but in reality, how do you make sure your business plan is getting executed, right? And then more importantly, if things are going not on track, which things always not going on track in the first place, right? And then what do you guys do in Lone Star to make sure it's getting back on track in reality versus your plan in the underwriting?
Yeah. So, and this is a good point, because when we underwrite a deal to acquire, that's setting up the basis of our financial projections, our budget, as well as the return metrics that we're projecting for investors. So it's kind of like that's the gold-plated document that we refer to, right? So we actually base our quarterly reports, our actual performance versus the acquisition underwriting. So we reference back to what we projected every single quarter with every quarterly report to see, are we on track? Where are we missing? What are we doing better than projected? So that always stays top of mind, and we're always comparing ourselves on a quarterly basis. So when we bump into challenges, which inevitably there's always challenges, we have to get creative and find ways to mitigate risk and get back on track, like you said. So for example, when we have a budget for renovations, prices could change, material costs could change, labor costs could change for renovations. And in the past, when that has occurred, we've had to get creative and think, okay, well, is it still worth it to do these renovations at these different costs? Maybe we can change the scope slightly of the interior renovations such that we can still deliver value to the residents and achieve a rental premium while staying in budget. So it's never perfect, but that's an example of how we're able to kind of think on the fly, adjust things as needed, and keep the deal as close to on budget and on track as possible. But there's also things there's challenges that there's nothing you can do about. If your insurance renewal comes in higher than you projected, there's no magic button that you can press to somehow get your insurance costs down. So that's just the name of the game. There's variables at play, and that's why it requires us to be diligent and finding ways to create value across the P&L and not getting complacent. We're always looking for ways to push revenue or reduce expenses. And I think that just shows, because in good times and bad times, we've been able to be transparent, communicate with our investors, and ideally deliver good news.
I think two things I like about your comment just now. One is you're being very real. You talk about all the experience from the past. What are the things that went wrong? And two, getting back to your early point, you want to see that from the sponsors. You want them to talk about the headaches, the difficulties they had before, right? You don't want to work with someone that told you like everything was fine, which is never the case, right? Which we know is a lie. It's not true, right? So that's really good. Also, you mentioned you manage them in a way that you guys are vertically integrated. Can you talk a little bit more about that? How does that work for you for Lone Star essentially?
Yeah, so vertical integration just means that we don't use outsourced or third-party property management.
Yeah.
So in 2021, my business partner and I, we launched our in-house management company called Radiance Living.
Okay.
So now we have Radiance Living, which manages our entire portfolio. And also the beauty of that is Radiance Living is a management company that we control and that provides us more hands-on control and transparency, but also focus, because typically speaking, if you're working with a third-party management company, that company is going to have many clients.
Yep.
And they're going to manage properties on behalf of many sponsors and owners. However, with us, our management team only manages our portfolio. We don't do any third-party assignments. So this keeps our attention solely on our portfolio, because our business model is such that at the management level, we're not looking to get rich off management fees. That doesn't make any sense. We're looking at getting rich off of the execution of the management, and that's how we all win together as sponsor and investors. So vertical integration fixes the disalignment of interest that exists in the third-party management fee business.
Yeah, makes sense. Is that also part of the reason why you guys only focus on very selective markets? Houston and Dallas, last time I checked, those are only two markets you guys are in.
Yes, that's exactly right. So, people listening might think, oh wow, vertical integration, that sounds fantastic.
Right.
Well, the downside is you can't be everywhere and be vertically integrated, right? Otherwise, you're going to be sending your people on planes all over the country. So what we've done is very deliberately focused only on first Houston, and then now Houston and Dallas, and then hopefully soon we'll also be in San Antonio. So these markets are all within driving distance of each other, and we have our management team is based in Houston, and we're actually opening up an office in Houston soon, which is very exciting as we continue to grow the team down there. So with that being said, our focus as far as acquisition markets allows us to be vertically integrated and have economies of scale. So if we own in Houston nearby and then we're adding another property, it makes us more nimble and efficient because we already know the area well and we understand the deal easier. And there's actually, last year, we bought a property in a certain pocket of Houston, and then this year we were able to buy a deal that was directly next door. And then the same thing happened again earlier this year, where we bought a property last year, and then a property that's directly next door came for sale, and we bought that, and we're able to manage them together efficiently, and it made us the unique best buyer for the asset.
I see. Does that lower your cost on aggregate level, then further increase your NOI from a scalability standpoint?
Yeah, it often can absolutely do that. And just to use our most recent acquisition as an example, it's actually a beautiful 2020 built property. And it's adjacent to a 2000 vintage asset that we own. And the 2000 vintage asset is 232 units. So that's a nice size scale. When you have 200 plus units at a property, you can afford to have a full clubhouse with an office with a property manager, assistant manager, leasing agent, and a maintenance crew.
Which is all in-house in this case. You're virtually integrated.
That's correct. And the property that came for sale next door is 90 units. So 90 units is quite an awkward size because it's not quite big enough to have all that payroll. You can afford to have a manager on site and maybe one full-time maintenance, or maybe if you might need an assistant part-time leasing, but part-time employees are very difficult to have in this space. So the beauty of having the 90 units next door to the 232 units is now we have over 300 units, and like you said, that becomes very efficient to where we can share payroll across the properties, and if a maintenance team member needs to go to the smaller 90 unit property, it's seamless.
Got it. That makes perfect sense. So you 2020 vintage and then 2000 vintage. So my next question is regarding that. what kind of the asset class you're looking at? Asset class A, B versus C? Like, for the audience, A is usually the newer property after 2010, 2020, you would say. Yeah, B will be around 2000, right? Plus C class will be 1980, 70, those type of property. How do you guys think about different property class asset? And then what's your target or favorite in Lone Star?
Yeah, our sweet spot is B. So we like to be right in the middle. The A space is newer and potentially luxury product, which is the most exposed to new supply. Because for a couple reasons. First of all, if you have a new property that was built recently and then a new one's coming out of the ground, they're going to compete directly on pricing, amenities, and and finishes and everything. So that's a tough battle.
Because they're always newer.
There's always something new.
Brand new,
Yeah, so that is tough from a supply standpoint. And then furthermore, if you are buying a property that's in a nicer area that justifies the higher rents of a newer product, you are going to be in an area that is highly sought after by developers. So you are just, even if there isn't new supply in the area at the moment, it's susceptible potentially to new supply. So that's the general fundamentals that somewhat scares us for those sorts of assets. Now the Class B space we think is a nice happy middle, because obviously if you go too low class, you buy an older asset in a rough area, you're going to suffer from physical challenges as far as the asset approaching obsolescence, and you're going to deal with high recurring capital expenditures. And then on the, if it's a low class area, you're going to be dealing with crime issues, collections issues, which it's not to say that you can't buy that asset for a cheap enough price to actually overcome those challenges and make money in that market. You could totally make money on those deals, but it's operationally intensive. So the B class space is a nice happy middle where you're not buying new product, and hopefully for us, we're very supply sensitive, so we like to try to stay insulated from new supply on the market. But it's Class B where people are making potentially $50,000, $60,000, $70,000 in income, and hopefully it's a decent tenant base that is paying their rent on time and not a huge nightmare to manage.
Got it. And which also still provides you enough room to do value creation on the property for B asset class, right?
Right. Yeah. So ideally, I mean, we buy deals that are, C assets, C plus, B minus, B. So there's a spectrum there. But we are generally looking to create value at the property in one form or another, whether it be through interior renovations, where we're modernizing the amenities and interiors. We're doing, lately something very popular has been adding bulk fiber internet. So we'll install internet at the property level, and then we'll actually sell it back individually and make a profit on every unit. So that's been something that we've been seeing more popular and seeing a lot of value in. But yeah, just constantly finding ways in the business plan that we can create value at the property and increase income.
Makes sense. And then what, I know this answer is different for anybody. What's a good deal to you? And then in today's environment, how hard is it to find such a good deal in your experience? Like how many properties you need to look through to really land one, bid one, and eventually get one for the investors?
I think the definition of a good deal is very diverse and
or your
individualized.
target, what's the acceptable or your return target in Lone Star?
Sure. I mean, the reason why I say it's very difficult to answer or it's targeted is because there's always a good risk-adjusted return.
Right.
So for example, if you're buying a brand new asset that there's very little risk in and there's not really much of a business plan to increase value, that should carry a commensurate return that will be lower than if you were to take more risk and have a more robust business plan. So there's ranges of returns that I find acceptable depending on the business plan. So whenever we're targeting deals, we always look at the returns, the projected returns of that investment through a risk-conscious lens. So we're analyzing the risk and thinking, okay, here's our business plan, here's the returns. How likely is the business plan to be successful? What are the pitfalls of the business plan? And what sort of return should we demand for the riskiness of this deal? So with that being said, generally speaking, we're targeting returns of somewhere between, I would say, 14.5% to 17.5% IRR, and that would be underwritten over a 3 to 5 year period, and that's with keeping leverage under control. And that's the other element that can really magnify your projected returns. And what I mean by that is, if you're willing to use more risky debt or higher leverage, that can make your numbers on paper look very attractive, but also create challenges for you if the business plan doesn't go perfectly or if the market shifts. So
essentially more risk.
Right? And so you should demand more return if you're going to take on that additional risk. So for us, one of our mantras is one of our main goals is we like to help our investors sleep at night. That's what we like. We like to sleep at night, and we want our investors to sleep well at night. And so for us, we would rather not pursue a 20, 25, 30% return and take on the big risk. We would rather keep risk under control and maybe target only a 15% return.
Does that give you any difficulty to get a property because you can't afford as aggressive pricing as other people in current markets?
It certainly, yes, it makes things more difficult as it was in the previous market environment. Now that we're heading into 2024, I anticipate the market to open up, and I think that there'll be really fantastic opportunities to invest at lower prices and with reasonably conservative capital structures. So I'm very excited about opportunities that are ahead. But there's always a bidding not always, but most of the time, the vast majority of the time, there's a bidding process, and there's usually somebody who's for one reason or another, aggressive enough to want to bid very aggressively and outbid everyone, and they're the one that's going to get the deal.
I guess you have to, I don't want to put a word in your mouth, but I would see my sponsor to stay disciplined, right? So don't just let emotion change your discipline, change your target at the last minute. Stay with that. If you cannot get the deal this time, just go to the next one.
Exactly. I mean, things often get stretched. I mean, we're talking about, in our case, Dallas, Houston, San Antonio. I mean, these Texas markets are some of the most
uber competitive
markets in the country, and for good reason, because the demographics and the growth trends are so strong. But with that being said, you have to get ready to compete, and you have to get ready to be willing to pay up and accept a lower return to be able to play in the game. And so for us, we understand that, because we've been there, done that, but we have to, at the end of the day, draw a line in the sand. And if bidding continues to push the price higher, we have to have our stop, and that's it. That's as far as we're willing to go.
Makes sense. So last question before the mini case study. I see a lot of people are start to be forced to sell their property, either because their debt is due, or they have floating debt, and then the new cap insurance is just too expensive for them. So how, in your opinion, how is Lone Star uniquely positioned to capture some opportunities in the next 12 to 24 month period?
Well, I love that question, and you're absolutely right. There's many challenges in the market that are starting to show cracks, and I think it's only going to get worse as things progress, and the owners that have that floating rate debt are going to have to contend with maturities or with very high debt service payments that they're going to struggle to make, right? And on our end, we're very fortunate that we only have one bridge loan in our portfolio. So that's an isolated issue in our portfolio that we can address and mitigate, and the rest of our portfolio is in good shape. So that puts us in a strong position to not be focused on legacy issues in our portfolio and mired in those challenges, and instead we're able to get aggressive and take advantage of, unfortunately, other people's challenges where they find themselves over-levered and burdened with high debt service because of the floating rate debt that they have. Well, we'll be able to take advantage, buy those properties at a discount, and reset the basis on those deals, and then be able to capture the upside. And what will be the real big opportunities are the individuals that are going to have challenges not just on their capital side, meaning the debt, but also on their operations. If you see a situation where the property is struggling operationally and it's under the pressure of very high interest rates on their debt, that's going to cause a really bad outcome where it's kind of a vicious cycle.
Yeah.
Because as the debt starts to constrain them, they're going to
deferred maintenance.
Deferred maintenance is going to pile up at the property. Their operations will get worse. They will suffer with collections, occupancy, etc. So, and that's when you're going to see the opportunity to go in and pick up a deal that's struggling operationally, and then not only be able to buy at a discount, but you'll be able to raise occupancy, raise rents, and really turn around a deal and make a lot of money.
Got it. So just going back a little bit, you said you have only one bridge loan. What means is, for our audience, it's usually a shorter term a flow rate debt, but across your portfolio, that's a very percentage of your debt at this point, right? Most of your debt is a long-term fixed rate type of thing. So on portfolio-wise, you guys are well positioned in today's environment. That's what you meant.
That's what I meant. Yeah, exactly. A bridge loan, like you said, is a riskier loan product because of the shorter timeline of the bridge loan, and that's what's causing a lot of the issues today. Because the bridge loan has both the shorter timeline, which is causing problems sooner rather than later, and then also bridge loans are mostly floating rate, and so as floating rates have gone up a lot, that's what's caused the debt service issues.
Makes sense. Okay, so would you mind give us a case study on your past deal, right? Hopefully it's went full cycle from the beginning to exit. I'll ask you a few questions, and then you just give us a little bit brief to this deal.
Yeah,
sure.
The
first question is, tell us about the location, size, vintage, price, and then the deal source, and then how did you guys negotiate the price if you guys did?
Okay, sure. So the property that we'll talk about is called Verandas at Bear Creek. This is a 160 unit property built in 1983, and it's in the northwest quadrant of Houston in the Bear Creek submarket.
Okay.
And this property we acquired for $11.5 million back in June of 2019.
Okay.
And it was actually a deal that we were tracking back into 2018. And we were just in a long, drawn-out negotiation process with the seller on the deal. And we were kind of bidding in the low 11 million range, and they wanted 12 and a half, and then they wanted 12, and we were just continuing to negotiate. This was an off-market deal. The seller wasn't, I guess, that motivated to sell quickly, but we just kind of stayed involved and stayed in communication to be able to keep the conversation going to eventually land at that $11.5 million price that we had agreed to.
Nice. Great.
So, yeah, that's kind of the origination of that
How
deal.
did you get to know the seller in this case? Because it's an off-market deal.
Yeah, well, even though it was off-market, it was still being brought to us through a local broker in the Houston area. So we didn't have a relationship with the seller.
Got it. My point here is, because you are so only focused on certain markets, you have deep connection with the broker in those markets, so they can bring you those deals which normally people won't be able to access to. I want to make the point there. The second question is, what's the business plan for this property, and what's the pro forma return that you have in your underwriting model?
Yeah, this property was interesting because the owner of the property did a decent job of keeping it in good shape. The units were recently renovated, most of them. However, the owner wasn't really focused on the property for one reason or another. So the property was in the low 80% occupancy.
Oh, I see. That's fairly low.
It's fairly low, especially considering the strength of the neighborhood that it was in. It's in a really attractive pocket of Houston. It's actually, even though that we've sold this property, we actually own properties down the street in this exact neighborhood. So we still like this area a lot. And the surrounding properties are 94, 95, 96% occupied. So when we looked at the deal, we thought, well, this is weird. There's no reason for this deal to be 80% occupied. So our business plan was to enhance the marketing efforts at the property and really drive leasing such that we could lease the property up into the mid-90s. And in addition to that, our business plan included light interior renovations where we were adding backsplashes in the kitchen, making sure the units were fully up to par, and then there was a handful of units that were in quite bad shape, just maybe about 10 of them. So we renovated those, and then we added washers and dryers into some units, and that's it. Pretty basic business plan. And from that, we were actually able to, from that small business plan, we were actually able to be very successful. Our thesis about surrounding occupancy was 100% correct. And we actually, through more hands-on management efforts and marketing, we were able to lease up the property from 80 to 90, all the way to 100, actually.
So it's fully
we got
occupied.
We got it fully leased, and then we stabilized into the high 90s, and that's where we just kept it there consistently.
Yeah.
And the
like from a return projection standpoint, what's your return projection at that time, and what's the actual return that you ended up with for this property?
We had projected to return about 16% to investors over a 5-year period.
Got it.
And because we implemented the business plan very successfully, and also we bought at a great time and we exited at a great time, we got some cap rate compression, which means a lot of market appreciation. And so we were able to deliver 36% returns for our investors.
Okay, that's when, how long is the whole holding period? For
34 months.
34 months, I see.
And along the way, we had projected 8.5% cash flows on average per year, and we ended up delivering 8.5%.
Great, yeah. Do you remember the actual equity multiple for this deal?
It was, I believe, 2.24.
2.24 over 36 months.
34 months, yeah, just about 3 years,
Yeah, so yeah, just put in context for the audience. This means if you invest in day one 100K in this deal, after 36 months, 34 months, right? After 34 months, you will get all your money back plus another 124K, right? So that's essentially the 2.24 equity multiple tells you. Awesome. Yeah, so what's your key takeaways from this deal specifically?
Well, I think key takeaway is trusting our eyes and believing in our business plan and our ability to execute. Because, frankly, we had a lot of investors push back on the business plan. They thought, well, if this deal is 80% occupied, what makes you so special that you're going to raise the occupancy to 95%, right? So that was more difficult to convince investors that we were well positioned to implement our management practice and be successful. So, but nevertheless, the numbers were, to us, was very straightforward. We just looked at the comparable properties nearby and saw how they were performing, and we thought, well, if we can just perform how the average property in the area is performing, we should be able to do a lot better. So that taught me to have that conviction when we think we're right, and not to second guess ourselves too much. The other thing that we learned a lot from this deal actually is we partnered with a very sophisticated private equity fund on this deal, and working with them was an absolute joy. They were extremely rigorous. They did so much due diligence on us, but that made us better.
I see.
We got more experience working with really savvy investors who asked tough questions. And as we were going through the deal, they didn't micromanage us, but we would jump on calls and share information, and when they would ask for certain analyses, we would produce those. And over the course of that, it was almost like we had a mentor and advisor for free, or they were paying us actually as an investor to help us and advise us. So we learned how they think about the market, and they just have a ton of experience. So that was just, I really appreciated that partnership.
Which makes you guys a much better sponsors, or more quickly become a better sponsor.
Better sponsor, better communicator.
Got it. Okay, last thing before we get out of here, what's your advice to new investors who is ready to diversify their portfolio and invest in this? Really, to me, it's one of the best asset class out there.
I think it goes back to the conversation we were having. I think when it starts to click for people and they understand the business model, they get very excited. And I think excitement is great. It's great to be excited, but don't rush. There's always going to be deals. There's going to be opportunities and sponsors to get to know and work with. So I think take your time getting to know the right people, and to develop your thesis. Everyone has their own goals when they invest. So understanding, okay, what are actually my goals, and then what is my investing strategy in order to accomplish my goals, and then going out into the world and finding people that are in alignment with your strategy and goals, and then building partnerships out from there.
Relationship, right? That's really the key of it. Okay, last thing, where do people go to find more about you and Lone Star?
You can find more about myself and Lone Star on our website, which is lscre.com.
Okay.
And on our website, we have a way to get in touch with us, as well as plenty of free resources, such as downloading our underwriting model spreadsheet that we use to analyze properties, as well as links to the books that I've written.
Sounds good. Yeah, I use that underwriting model a lot, by the way. I love it, especially the sensitivity analysis part.
Love that.
Yes, yeah, that's really handy. All right, it's been a joy talking to you. I learned a lot for sure. I'm sure the audience will feel the same way. So thank you so much for your time.
My pleasure. Thank you so much.
Thanks. Yeah. Alrighty.